Welcome, folks. I previously went through sections 1, 2, and 3. The last part was a two-part sequence, going through the numbers, version cap rates, things like that. And in this installment, we're going to be going through the LP checklist, which is an attempt to pull things all together. So if I'm to summarize section 3 and 4, the people and numbers is really the two big parts of due diligence investors need to undergo before taking that leap of faith, as I did back in 2016 when I had a bunch of rental properties and shifting over to syndications and private placements. What makes people uncomfortable is you're giving up control. Although you're signing all these securities in exchange, legal documents, which makes me feel really more comfortable these days because it is very robust type of document. Now I have to vet the people that I work with so I can eliminate the counterparty risk and then also evaluate the numbers. And in the numbers section, we really talk about what are, like, aside from all the things that I think semi-sophisticated investors look at, which is the splits and fees, most times that's all pretty much a wash. And it really comes down to, all right, what are the assumptions that the operator is using to get to the numbers at the end of the day? Because if investors are being very aggressive with their underwriting, it could mean that, sure, like on paper, the deal looks like 100% return in 5 years. But if we normalized it to standard safe underwriting using a reversion cap rate of a plus 0.5%, or assuming that the rents are going to go up 2% every year instead of 3% every year, it may mean that 100% return in deal in 5 years comes down to a 60% return in 5 years. And therefore, investors need to normalize this. This is all trumped by the people you work with. And I've always said it before that I've made mistakes, right? Like I'm working with the wrong people. There's a lot of these kinds of educational groups out there that kind of teach people how to get started. It is just teaching people how to market themselves on the internet, faking it till they make it, looking like they have this long track record where we've gone through this since we started back in 2017. Right now, $2.1 billion of assets, 65 projects. We've learned a lot through the process. But I always tell people, investors today, be wary of investing with anybody under $1 billion of assets. Because, when we were there, I got to admit, we were still trying to figure out things as operators. But this LP checklist that we're going to be going down today is somewhat pulling things together. And of course, in the syndication e-course, at the very bottom, there is this resource where you can go and download the checklist in the spreadsheet form, where a long time ago, the numbers have changed in my head a little bit. But there's an attempt to somewhat weight these different aspects together in a spreadsheet form to evaluate deals. And again, everything I'm talking about today, take with a grain of salt. Do not be that passive investor that asks a sponsor all 30 questions, even 10 questions. I think that's ridiculous. And a lot of times, if you work with a good sponsor, they're probably going to want to ghost you through after the 5th robotic question. But these are just questions that are made for you to be more aware of, and then come out to one of our test drive events and meet other passive investors to have these types of conversations. The whole idea of this e-course is to get educated up to a certain prerequisite level and then have good conversations with other real investors, as opposed to the online forums or the free Facebook groups that you see out there where people are still going back on fees and splits, the real surface level type of due diligence. And going into that more in a little bit detail, this is exactly what I'm talking about. Semi-sophisticated to new investors will key in on really the things that don't really matter. Like you'll have a pitch deck where something's similar to this, right? Like you look at the splits and the minimums and the preferred rate returns. That's just surface level stuff, right? What we want to do is dig in and get past the structure, splits, and fees. Again, there's this Google document that you guys could be able to download once you're in the e-course that kind of pulls it all together here. Make sure you guys right-click to download it. But here is what it looks like. As you can see, a lot of this stuff, again, don't fill it out, guys. This is not school anymore. This is just things to think about. You're not going to get all the information. Don't be one of those investors. There's a weighting system here, like I said, and certain things are weighted a little bit differently, some more than others. And it's split up between the people section and then the deals and numbers section. Opinion, passive investors are not going to be underwriting specialists. So digging into every line of income and expenses is just not going to be in an investor's scope. Some of the most astute passive investors, maybe the top 10%, might spot check what the operator is using for combined expenses, for example. A general rule of thumb at one time was that all expenses per year was about $4,000 per unit to run a Class B asset. Today, that might have, with inflation, that might be $5,000, $6,000 per unit, but that's a good spot check right there. And what I mean, you're not digging into every line item. You're not going into like repairs and maintenance and seeing what they're using there or advertising. Some of the more top 1% LPs may be digging into, look at this property. It's like on 20 acres for 200 units. That's quite a bit of surface area there. Therefore, maybe the landscaping and the snow removal line item might be a little bit bigger. But that's, again, this is just not in the scope of a passive investor. And this is where I think most investors, like when they're starting out, they like to dig into a deal where they can see it and they can understand. You're investing a 76 unit in Phoenix, Arizona, and you know what asset you're buying. And I get it, right? You like to have some pride of ownership, you like to vet it, but really most investors starting out should really invest through more of a fund model where you're investing through a reputable operator within a pool of assets. So an example, I'm notorious for going to Costco and buying the really expensive strawberries with the mold in it. Maybe you guys are out there too. I just don't check it. I just don't think about it. I throw it in the basket and I go. So I'm one of these guys that I just know this of myself. And when I go to Safeway, I'm not going to go pick out individual apples. I'm just going to go buy the cheaper prepackaged apples. And that way, when I come home with subpar apples, my wife doesn't get super, super angry at me. I'm just not sophisticated. Part of it is I don't care about that stuff, particular stuff. I'm more worried about investments and money. Similar, when you look at these syndicated deals, to take that type of mindset, most investors should start out with diversified pools of deals. So a lot of these funds will be put together with 5, 10, 15 assets all put into one. And because, quite frankly, you don't have the sophistication, or you may never get the sophistication to underwrite or take a look at each individual asset. That said, most investors will not listen to what I just said, and they're going to want to have that pride of ownership before picking. Now, I have a certain level of expertise as an operator in apartments, but when I get outside of my world of apartment investing into, say, mobile home parks or industrial, I'll say industrial specifically, right? I started to investing as a passive investor in industrial years ago. And when I first started, again, I don't have the operational expertise in this asset class. So I'm just like an LP like you guys. I wanted to know the market. I wanted to see, the deal, and industrial, it's all the same thing. It's just boxes, right? So it's, again, I'm like, why do I think this way? But I wanted to pick, right, the individual fruits. And at this point, around when I got to like my 4th or 5th investment in this sector, I was like, all right, I don't even know the companies' names, meaning the tenants that are in the industrial facility. And I don't even remember where these things are at. I don't even know what the deals are called. And I got to a point where I'm like, all right, I don't care anymore. I'm just going to invest in this sector in industrial where I'm not sophisticated in a fund model. So I can get the diversification so the operator can allow that diversification for me. Because I think a lot of what I've discovered from a lot of investors, you guys will jump into these types of deals with maybe 10, 20% of your net worth. A lot of you guys are million plus net worth. So a couple hundred or maybe even a few $100,000 into these deals. And if you're thinking like most of the minimums are $50,000 to $100,000, you may not be in more than 3 to 6 deals getting started. And that is not diversification. To me, diversification is at least $500,000 into a dozen deals. So this is where I'm like, especially when you're starting out, you're very vulnerable to 1 or 2 deals going bad or investing in the wrong part of the market cycle in terms of timing. And therefore, a fund model is ideal for you. And again, if you can get a sense of pushing people towards the fund model, because it's against people's where they start off with. Again, this is most investors, they only go into a handful of deals, and that is not diversification. The checklist is put together with the people. So that's these items here. And then the deal overview, the investment part. And I want to separate that against what I think most people call the numbers. which is like the 6% preferred return with a 70-30 split, then waterfall after you hit 13%. Every deal is a little bit different. It is very overwhelming for most people getting into this world and start speaking the lingo. But trust me, after a year or two, it becomes very second nature. Anything that comes at you once you get familiar isn't too much of a surprise. And unfortunately, like I think people love to talk about this type of stuff because they fixate on it because this is something that you can intellectually touch and compare apples to apples in a way. Again, this is a very small portion of the due diligence. Majority of it is in the underwriting of under the covers and the deal, which most LPs will not have a full understanding of. But I just want to draw people's attention to that because I think this is a big mistake where I see a lot of these online groups out there and they fixate on these. When people have an understanding of a certain area, they fixate on it. And I'm definitely saying here that this is the wrong stuff to fixate on the other stuff that we talk about in section 4, the due diligence part 2, the numbers section. Go back, and that's pretty much the huge meat of this OE course there. Just because an operator says there's going to be a 2x equity multiplier in 6 years or whatever, that doesn't mean that they're going to get it. These are all projections. Even preferred rate of returns are not guaranteed. Sure, you get paid first at that, and you would think that the operator wants to make money, and therefore, they want money for themselves, so they're going to work to perform past that preferred rate of return. But none of this is guaranteed. And especially when you get to newer operators, a lot of them are just using the same cookie cutter splits and fee structures and preferred return structures. And they are potentially using subpar underwriting, or they're just newer operators. Dev, Brad, you want to come off mute? I've seen you guys having questions. This is the time to ask it. Because a lot of this stuff is more discussion based, or read a 500-page book that is wishy-washy. This is the time to ask it and have the conversation here.
So first of all, just going back to the preferred return, some of these are legally binding. It's a hurdle that they have to hit. So I mean, there is some apples to apples, but in general, in your experience, I mean, point taken, do you just completely dismiss the numbers that are given in terms of projections, or how do you put them in context to help you make decisions? Should we just right away dismiss that and just look for really solid back deals? I'm assuming that if you're just looking for the Class A stuff, there's going to be a give and return. You've got to be able to balance these things in some way. Can you give us some perspective on that?
Yeah, so let me break down the question. So I can answer this a few ways. Thanks for jumping off mute there. So as far as prefs versus total projected return. So prefs are like, say there's a 6% pref and then a 70-30 split, versus the projected returns. Maybe they're just saying 96% return in 5 years. Out of those two, you mentioned like you just steamer over it, you ignore it. Which one are you saying that you are considering, one of the two? And
I'm just looking for a framework for all of it.
let's do the first one first, the preferred rate of return stuff. This is my personal thing, and everybody has their different styles. At least here we establish what the heck is a pref, right? So a pref is like a hurdle that you have to overcome for the next waterfall to get enacted. And most times in multifamily, your split schemes and your pref schemes are pretty simple. So if there is a pref, there's only one more waterfall or hurdle after that, which is when the general partner carried interest gets brought into place. Whatever the split scheme is, I just see it as a wash at the end. I don't really pay much attention to it. What I look at first is, all right, what is the total return? And obviously that could be fudged, right? That could be plus or minus 50% one way or the other. So it's really silly when a passive investor doesn't want to do a deal because it's 84% return in 5 years. And then this other guy has a deal that's 97% return in 5 years. That's a complete fudge factor right there. But I think the first thing is to look at, hey, does this meet? Most times I look for a deal that's hitting at least like 70% return in 5 years. And then I start to dig in, because you have some deals where the deal is underwritten really great. They're sandbagging some aspects of the deal where it could really outperform. And they could say it's 75% return in 5 years. If it was really underwritten like the other guy, it'd be 120% return in 5 years, and vice versa. Let's talk about that pref scheme first, right? Do you understand why I'm just steamrolling over it?
Yeah, I think you're right. It's better to focus on like equity piece. Is that what you're getting at?
It's more like, hey, is this Sometimes you have these types of deals where when you really look at it and you scratch your head, it's, wait a minute, you guys are only going to give me 10% a year. That's what the stage one is, just disqualifying those, because these are either like institutionally operated deals, right, where they have really high fee structures and really bad splits. But regardless, like you're just not going to get that much returns as a passive investor. And this is where the concept in the wealth elevator for people between $1 to $5 million net worth, you need to go into syndicated deals with not institutional operators that you see a lot of people talking about, but people who are in that middle market world where you still are able to get those mid-teen type of returns or better. So that's just the first kind of qualifier. Then you dig into some of the deal assumptions from there. But again, this is just my way of doing it. Like, I don't really look at the pref or the split scheme, because normally when they have a stated like projected return, that's all splits and fees are accounted to get into that.
Okay, so setting the preferred aside and just focusing on the whatever class B or equity piece we would typically in, when you see somebody put a stated 18% or 21%, do you outright dismiss that? And do you just make an assumption on your own? Okay, for these types of deals, whatever it is, class A, class B, et cetera, I'm just going to assume this type of return for planning purposes. Or do you take stock in what they put out there?
Maybe give me an example, because this is where I'm a syndicator and sponsor operator. So I know all the little tricks and games. And it's funny when I read some of these decks, I know exactly what they're doing. Let's talk through it.
If we just pulled up something generic, like if you pulled up like whatever Realty Mogul, they'd have, I don't know, they probably have 6 deals out there, and they're going to have varying levels of return expectations. Do you put any credence in the numbers that they put out there on those deals? Or do you dismiss those right away and look at other things? For a lot of us, you're right. That is the information that we have in front of us. And so we're trying to make some sort of qualitative judgment, and we're trying to come up with some sort of framework as to how to think about return and risk.
Yeah. If you're going to a crowdfunding website, a broker dealer, there's another set of middlemen. I think there is a huge false sense of security with going through one of these platforms. That platform is doing your due diligence, and they're absolutely not. Maybe one could assume that they are at least calibrating and making sure everybody's using the same set of assumptions so that the ranges that's stated there is somewhat apples to apples, all things being equal. But you cannot count on that. Their job is to take money from the operator and put it on the platform, just like buying things from eBay from random sellers out there. But that's a good starting point. I don't put too much to it. If you're evaluating like an industrial deal, giving you 70% return in 4 years, and then a multifamily deal giving you 95% in 6 years, obviously 2 different annual rate of returns, right? When you divide it by the total number of years in those two. But I would say, hey, good enough, close enough for those two examples.
So if
And
I
then,
can repeat back what I think I'm understanding is you don't put much credence in the numbers, the stated numbers. You typically use a range based on asset class for history if you're going to get involved in one of the deals. Is that fair?
yeah, one of my criteria is I better be hitting more than 10% a year. If not, I'll just do something else. If say a deal's 70-80% return in 5 years, and for some reason I want to add industrial to my portfolio, then now let's dig in, and then we go through a lot of what we talked about in section part 2, the numbers here, and then we dive in and, hey, what are some of the deal assumptions after that point?
Okay, that's really helpful. Also, a follow-up to this is on for equity, it just doesn't seem like there's much by way of cash flow. Certainly for someone like me that's just getting used to this over the last few years. Do you just dismiss the idea of cash flow in the near term flows, distributions, and focus more on the long-term payout? And if so, how do you manage cash in the meantime? Do you ladder these? Can you give us some thoughts on that?
Yeah. Whenever you're getting more than 15% a year, you need to have some value add component. That's what we're all here for, right? Beating alpha. To me, if you just buy a hope and pray model, you're probably going to be under 10 to 12%. So anything higher than that, you're probably doing some value add. And with value add, you need to wait. You need the bread to bake in the oven. So again, I don't know where people are looking for their deals, but I'm just generally thinking if you come to our world, you're already in the world of these business plans where you're adding value to a project. And it's going to take some time to rehab units or do construction, or if it's not physical additions, it's a management play. This stuff doesn't happen overnight. And for people who ran businesses before, you need to have some patience with this stuff. So there's a trade-off between, and I think a strange expectation of newer investors, they want cash flow and they want total returns at the end. And this is a case where I think, I don't know if it was a Buddha line, but you can't ride two horses. You can't have cash flow and total huge returns. It's either one or the other. So that's where you've seen offerings where it's very cash flow heavy, but the total return isn't there, right? Because it's not that type of investment. Whereas like a development, for example, there's no cash flow. You need to build the damn thing, but there's bigger pop at the end. So in most cases, if you're looking at a deal that's higher than 14, 15, 16%, it's typically more of a value add. And you may have to wait at least 6 months, maybe even a few years to wait for any cash flow. But this is just the marshmallow study in a microcosm, right? You have to delay gratification to get higher returns.
Thanks. That's helpful. And so how do you personally manage that cash flow in the interim? You've got to, so it's, you're waiting for back end payouts. I think that's your answer.
Yeah.
In the interim, how are you managing the cash flow side distribution?
I mean, keep your day job, dude. At one time, the brand was called Simple Passive Cash Flow. And for me, back then, it was to get cash flow to replace my W-2 job. And now looking back, that was a very nearsighted type of a goal for myself, right? To just rid myself of the W-2 job. What I lost sight or just wasn't aware of back then, and what I hopefully people can glean from just this little tidbit here, is that the goal is to increase your net worth past 3, 4, 5 million. And if you're already there, go to 5 to 10 million. And the way you're going to do that is with value add and deferring cash flow. Now, I always overlay on top of this, and this is one of the big concepts of the Wealth Elevator book is, hey, define your end game, figure out what that number you need, and that's defined as a passive cash flow number. And once you get there, then cruise control your way and just cash flow and chill. This concept, it's a little bit different for everybody. Higher net worth investors, people over 2, 3, 4 million plus, they have this attitude of thinking over a large time horizon. Their perspective is very wide and very zoomed out, where they're looking at things at the 5-year, 10-year, multi-generational timeline. They don't care about monthly checks coming in the mail, quarterly checks. They're good. And maybe they've gotten there because obviously their net worth is huge, but they've taken maybe 10% of their portfolio and put it into things that merely make them 5 to 10%, but cash flow now. So that's a start there. I would say look at your own portfolio and start to slowly titrate that amount up. But if your net worth is under $2 million, you may have to just focus all your troops, your money onto growing it. So then you can pull it back in that type of nature. So it's very dependent on where you are at in terms of the wealth building journey, the wealth elevator, what floor you're on. I got an image here that I'll share, pull it up here. There's a real rudimentary type of diagram here, but you can get to your goal in several ways. And this is taking a guy net worth 1 to 2 million. Some people have the attitude of, I need cash flow because I'm a nervous Nelly and I like to see the cash flow jumping in the bank account every month, every quarter. And I think that's definite understandable. But to me, if you have a day job, this is the path that I think more sophisticated investors go off of. They understand the risk reward and they understand the worst that can happen is they don't get cash flow. Or of course, every investment, there's risk too, right? But their attitude is let's go and take some chances in the beginning. I'm still working my day job, so I still have food on the table. I'm not living out on the streets, but that's how I'm going to be more equity growth focused. And that means no cash flow type of deals or portfolio. And this is why we got away from the simple passive cash flow brand, because most of our investors, they have good jobs or they have just enough money where they don't care about cash flow. They're more about generational wealth and building it. And quite honestly, most of the projects we do are value add in nature and there is no cash flow. Any follow-ups to that, Brad?
No, I got you. Yep, that's all clear.
I will say back in the day, houses were 50 grand. And back in the day, college was what, $5,000. But back in the day of apartment investing, when I first started, and mind you, this was in the golden age of apartment investing when the big boom in 2015, 16, you could put your money in deals and get 8% cash flow starting after the second quarter and double your money in 5. Now, a huge part of that And where I think you got to be wary with a lot of track records out there who've built their business in this time period was everybody, any idiot could have made money in that era. But just strictly speaking for passive investors, you could have both. You could have a great cash flow stream at 8%, 2% a quarter and double your money. But that ain't around, guys, anymore. That was back in the day, past 2020. That ain't happening anymore. Expensive gone up, interest rates have gone up, and obviously the cap rates have bounced back due to interest rates where the market evaluations are less. From 2009 to 2022, you had this consistent step down in terms of cap rates, meaning the prices just getting stronger and stronger. That's a very ideal situation to be investing in. Now in 2023, we've had this great reset, which is a great time to start investing now if you're coming at it at this point now. And hopefully it can do that same consistent step down. But that's where like most of these value add type of projects, the money is made through the value add and at the end of the project. And it's those golden era deals, like I said, it used to be half of the money you made through the cash flow, 8% at 5 years is 40%. And you get the nice 50 to 60% pop at the end. Maybe a little bit on the equity at the end. And this is a dream, right? This is when the good old days. As time went around to the late, right before 2020, it was more like 1/3 of the money that you got or 1/4 of the money you got was through the cash flow. And then 2/3 was through the built up appreciation. Again, the built up appreciation part of there is force appreciation and market appreciation. Market appreciation is dumb luck, right? Too. Let's all call it what it is. Now in this, everything's changing and it's never going to go back to what it was. Things always change. Who knows? It might even get better. I don't know. But right now, what I see going into 2025 and beyond, I don't think that you can count on cash flow being that strong, maybe a fourth of your total returns. But if you're able to piece together couple dozen of these deals, even at a paltry 1 to 2%, that's what's the aggregate total of $1 million invested at 1 or 2%. It might be enough for somebody to sustain their monthly burn rate without working a day job. But most of it's going to come at the end, right? And this is a concept, I think, that wealthier people understand. We all talk about cash flow is king, cash is king. These terms get thrown around all over the place. But I know I can change a chunk of money into an income stream all day. I can't really change an income stream into a chunk of money. It's not super interchangeable back and forth. I know that's a little esoteric, but if you stop to think about it, people come into our world and they think, I need cash flow, I need cash flow, I need cash flow. And you may be right, but sometimes a chunk of 25 grand, 50 grand is a lot better. So some of you guys are real estate agents. Some of you guys want, the allure of having, you want what you don't have is the general idea. That real estate agent may want passive cash flow so he doesn't have to keep working, right? So he buys all these rental properties to get this nice cash flow income stream of $5,000 per month, and takes a lot of effort and work to do that. But then I look back and it's very counterintuitive to what you hear in this kind of space. And I tell that real estate agent, dude, just go sell a multi-million-dollar house in Hawaii and make a $50,000 check. Boom. And when you divide it by $5,000 at 50,000 divided by $5,000, that's 10 months of cash flow. And you see how you can convert that one way or the other. Just don't be a drunken sailor and spend the $50,000 commission check, right? I think that's where there's some self-restraint and being fiscally responsible with your money comes into this a little bit. All right, next question here. In the situation where the general partner doesn't meet preferred rate of return, let's say the preferred rate of return is 8% and they are at 3% due to current market situation, what is the GP making? Are they cover costs? A little bit of review. So the preferred rate of return typically means that the LPs get that paid first. In this case, say the market conditions aren't where it's at or something happened, the GP needs to catch up with that remaining 5%. So 3 plus 5 is 8% to hit that pref to make money. And this is where, and we cover this in the numbers section in the e-course, there is a dark side of the syndication world. Sometimes the GP can fall behind and they lose incentive, right? You want to have a healthy structure where the GP is incentivized. What if they're like, screw it? It's like the NBA. If teams fall behind in the end of the year, now they just start tanking games. In a way, it can happen out there with these types of syndicated deals. They start to put their good property manager on one deal, and this deal that's shit the bed from the beginning, who cares at this point? They're not making any money. Most times there's some sort of acquisition fee and asset management fee in there to cover the revolving costs that operators budget. And this is where it separates the newbies who are still working their day job, who are still doing it all themselves. And I think we crossed over this phase in 2020 when we went over $1 billion assets. It's expensive, guys, to run these companies. My payroll these days are like $500,000. Some of these other operators are like $1.5 million, $2 million per year in staffing costs. That's where the acquisition fees go. That's where the asset management fees go. It's to put professionals that are better than us on the projects to manage the properties properly on top of the property management, which is third party.
Yeah, it does. No, thank you for that. A follow-up question, and it may have been covered in some of the earlier sessions. In one of your modules, I think you talk about asking questions like, and one of the questions was around capital calls to evaluate the sponsor. But in the current market condition where almost everyone has had a capital call, is that still a relevant question, or how would you modify that question?
So operators that started in 29 and after, they probably never had a capital call until 2022, 2023. In 2022, interest rates got jacked up, the quickest time in history, a 40-year phenomenon. And what it comes down to is a lot of operators will use a certain level of safety, specifically speaking about the reversion cap rate, right? The reversion cap rate is what you assume that the property is exited at. If you go back and watch section 2, I talk about this in great detail. I'm just speaking for ourselves. Like, we'll typically be a little bit more conservative, your most professional institutional operator out there. Some of the institutions will use a reversion cap rate or exit cap rate of 0, or maybe they might even assume that they're selling it into a stronger market and use these. They'll say, well, we're doing value add, so we're changing a B class asset to a B plus asset. I don't quite buy that, but that's just what institutional operators do. I've been to one of these real conferences out there where there's none of these talking head influencer YouTube kind of guys. And I've asked the question in the stands of these institutional operators to T-ball them up. And I was appalled by that answer myself. But most people in our ecosystem should and are using like an assumption that the market will deteriorate a little bit and use a reversion cap rate of 0.5%. At one time, we were using like 1%, which is much more conservative this. But what we've seen in the past 6 months, especially in late 2023, is an acceleration of the cap rates where take Phoenix, Arizona, which is a great example of this, a huge swing market, cyclical market. The cap rates at one time, you were buying properties at a 3.5 cap rate, and then it went up to 6.5. So we'll even say it's 7. Basically, you lost 30-40% of your market value because it comes down to price of the properties in commercial real estate. Doesn't matter what asset class it is your net operating income divided by that cap rate. And that is magically what the property is worth. So if you have a net operating income of $500,000, I mean, you guys can do the math at home. Let me just do it. $500,000 divided by 0.035, which is 3.5%. That property is worth approximately $14 million. Take that same property, $500,000 net operating income divided by 0.06, and now it's worth $8.3 million. You just lost what, $4 or $5 million right there. And this is where you see that denominator again, net operating income divided by the current prevailing cap rate is a huge deal. And most models, like I said, absorb maybe 0.5%, a full percent point. But when it goes up 3-4 times that, that's when it breaks the model. And that's what basically happened this past year on those deals. And that's why you diversify out over time lengths, because for cap rates to be that high can happen. I guess happens every 40 years, but doesn't typically happen all the time. Maybe 90% plus, it never happens. But that's whereas I think as a passive investor, you look at that and you're like, all right, risk reward profile still makes sense. If I'm in a deal for 2 or 3 years, maybe we can exit out in that time, make more money. But certainly, especially if you're in a deal with floating or non-floating debt or longer terms on it, meaning 5 years plus on the note length, you can probably be immune to these temporary blips in the economy or the interest rates and the cap
Right.
rates.
No,
So
thank
that's
you.
why I say having a diversified portfolio not only means different geographic areas and different deals and different asset classes, but I think the biggest thing here is all asset classes are impacted by the economy somewhat. It is correlated with the economy. The biggest thing that people need to look at to diversify portfolio is just timing. If you can space your portfolio out over 4 to 7 years plus, have some 2018 vintage stuff, 2019, 2020, that's the best way you're going to bulletproof your portfolio. Like once you have deals that have been simmering for 2 to 3 years, you don't really got to worry about it. You can withstand these 40-year floods in a way. But yeah, that's the general partnership. That's why I get paid the big bucks. And sometimes I even think, man, maybe I should just personally stop doing this type of stuff because it is a lot of risk. The GP gets paid really at the end due to carried interest. And I know I get it. I think a third of the investors out there look at the acquisition fees as a big thing. And it's not. If a company is running a legit business where they're putting the money back into building teams and processes, then there's no money there. It's the newbie operators who are still working their day jobs. They're still doing it themselves and not really building long-term companies. Those are the guys that, yeah, you probably are like, what the heck happened to the acquisition fees, man? But that's majority of the money from the general partner's perspective is made at the end, the carried interest. And that's where you see some waterfalls where, and I personally don't like these things as a passive, but now I'm coming around to it too. I see it as fair that the general partner taking majority of the upside. So meaning these types of waterfalls where you hit once investors get 2x their money back, the general partners, the split goes from a 70-30 split down to a 50-50 split. So the GPs get more of that upside. In a way, that's fair, right? Now I'm getting more versed in the venture capital world. Some of these venture capital deals, the investors get fully exited after they 3x their money. Obviously, I think that's a different world where you're pre-revenue and less robust assets, more businesses than real estate. So it's a lot more riskier, also a higher upside. These splits, I think you can drive yourself crazy by analyzing this stuff. But for the most part, when you're in the real estate world of these value add type of projects, there's somewhat of a subset of splits most people will use, and it's standard. And I'm relearning this myself as I'm ingraining in private equity and venture capital outside of real estate world. Like they have their certain split schemes and pref schemes that they like to use. And at the end of the day, it's a deal. Just no different than a certain computer programmer gets paid $150,000 to $200,000 with X amount of years experience, right? Like I think if you're thinking about it too much, I guess that's what you are when you're starting out. So I guess that's understandable. But if you just invest more, it just doesn't really matter at the end of the day.
One other unrelated question is, in one of your lessons, you play around with a spreadsheet where you start adjusting the occupancy rates to see where it breaks and you start losing money. And I found that quite cool. But I think the challenge is when you take a look at the PPMs, you just get a sort of a summary slide with the ballpark numbers. You don't really get a pro forma spreadsheet to play around. What is the recommendation around how you should be using those skills that you teach with the limited numbers that are shared in the PPM?
Yeah, so for everybody's understanding, what we're talking about here is, I think it's in the e-course somewhere, but there'd be videos of me playing around with like our underwriting spreadsheet. And it's a standard spreadsheet that it's the same dang thing everybody uses. It's not something special. You would say you have 100% return in 5-year deals. All right, let's fudge some of the numbers, right? So that we can they call this sensitivity analysis. How low can occupancy go before we start to lose money every month? Unfortunately, and this is part of my own education, you get better. It's not just like occupancy dips. When you have certain things happen in the economy, there's multi-factors that come into play that compound the issue. So it's not as clean as occupancy going down to 45%. Now you start to lose money. You have to also account for the contractor fees going up, this going up. And hey, that's the life that we live in. There's uncertainty out there. But I think when you're starting to compare apples to apples, this is really cool to do, this sensitivity analysis. And sometimes operators will provide this. And the two factors they'll use is when do you start to lose money, when based on your occupancy percentage. And then, all right, let's play around with that reversion cap rate in that. Then you can see the ranges of possibilities. But that's where that spreadsheet typically does not get released because it is proprietary. They don't want it to be sent out there. But if the deal does not perform or whatnot, there is always that information can be used to harm the operator greatly. So that is where reputable operators will never release that type of information because of that liability. And that's ourselves included. Like the people who do release it are the very unsophisticated newer operators that have to drive to your house, lean over so you can sign your PPM document. Like the guys are bending over backwards to get you to invest with them because they're desperate for money. You may be that type of investor who likes that white glove treatment, investing with a newbie. But a lot of what I say is guidelines, right? Like I generally would not invest with anybody under $1 billion, let alone $250 million, $250 million assets under ownership. And I think it's hard to find an operator who's done more than $250,000 of deals who will give you that type of resources. If that makes sense.
Yeah, at the end of the day, it's about trusting the operator and their experience, because a lot of the number crunching and everything, you won't have access to the spreadsheets that is used to do all the number crunching at the back end.
Yeah, I like where this is going, right? Like I can get a sense that you're heading in the right direction with this kind of more holistic understanding. A lot of times you won't get that information right away, but the whole purpose of the numbers section in the e-course is like you can do your own little, like they may give you the P&L snapshot, right? And then you can figure out what they're using for the rent increases per year. Or a lot of times that reversion cap rate will be given in there. You just got to know what to look for. And I think there's an art to asking certain amount of questions without being a difficult investor. Some people cannot do that. And those people without those coy people skills to get the right questions answered without being a total nuisance, that's a valuable skill. But also think about from the general partner side, right? Like they're trying to grow their business, or maybe they've already got a mature business. They don't want somebody asking a question every other monthly report or every other quarterly report. That's not the type of investors they want. If you guys are like those types of investors, don't invest with us. In fact, just go on Google and type in Capital Raising Summit and just go invest with one of those newbie operators out there. Please just do that. Go away. At least speaking for myself, we just want to invest with good people who trust us. And again, this is a joint venture at the end of the day. We're using very standard split schemes. We're taking a chance. You're taking a chance. Like we're all in this kind of together is my attitude, good or bad. But I think I could probably make some counter arguments for myself, right? Because there are some like rogue operators out there that are just doing super crazy things with their underwriting. And hopefully that's what this is supposed to catch. But something you said earlier triggered something. So around 2016, like me and my partners we were starting out at that time, always like, where are the dinosaurs that have been doing this since 2010, or even prior? Where are these guys, right? Is the dinosaurs, did the meteor come and hit these guys and there's no longer here? Where are they? What I've discovered, and I could be wrong, the operators either become very institutional and they start to just find an investment banker and they tap into lazy, dumb retirement Wall Street money. And they stop working with investors that ask them 30 questions about this and that and taking all these risks with being paid last as the GP. And I asked myself, maybe we should do this one day. But I like the energy, right? And we're all in this together. Like this, we're cutting out the middleman. But that's at one time I thought, yeah, let me go find these very institutional operators, these people with long track records and experience, and let me invest with them. But then again, you're not going to get the returns that you're going, instead of doubling your money in 5 years, you're going to be doubling your money in 10 years. So you price it out. For some of the more wealthier people above $4 or $5 million net worth in our family office group, I may suggest some institutional operators. Of course, I think what you'll see is I'm going to try and use our collective bargaining power of our group to get some better splits and fee structures to get into some of these institutional operators. And also some of the institutional operators, they don't take minimums less than $250,000 or $500,000. So you're priced out already if your net worth is only $2 million. And institutional operators, more power to them, because the higher the minimums go and the more wealthier the investors, the less trouble and BS an operator needs to go to, if you see it from their perspective too. But this is where, yeah, so again, operators either go to more institutional money sources and stop working with little peddly investors. And because it's a huge investor relations issue, we hire a lot of staff just to answer investor relations questions. It's a huge cost that I think a lot of institutional operators wanted to get away from, and then the legal liability of that, or they change to different asset classes. So what that means is they get out of doing value add multifamily class B and C, as we have. You've seen us do this, get away from like buying little 50, 100 unit pieces of crap where things break all the time. It's really hard to figure out a good rehab budget because things are just breaking left and right. It's saying grandma's good to go to the assisted living facility. She sprained her leg, or this 5 years ago. But then as soon as you send her, now she breaks her hip and, gets amnesia, or, does this, right? That's how these 80 property and older are. And then we've seen that even with some of the class B and A assets, things just break and there's still always uncertainties. And now I'm like, oh, now I see why these institutional operators are just buying class A assets or building it brand new. So they don't have to deal with all these uncertainties and lower level clientele in terms of the tenants. I think that's the worst part of class B and C multifamily. So you have this echelon of operators, right? Like you have these newer operators that they don't mind getting their hands dirty and taking a lot of risks. No different than, I think maybe if we look down at the guys doing the burst strategy with little rental properties remotely. They live in Seattle, but then they're buying a house in Missouri. That's crazy if you ask me. But with how much capital they have to play and their networks and accessibility of deals, that's the best that they can do. It's still a good risk-adjusted return for them. But as you start to climb this ladder of operators, you start to realize that there is a lot less headaches associated with returns. And I think passive investors who, in a way, or you need to join up in one of these types of partnerships, you need to understand that this constant dynamic. This is why you've seen us go more towards developments or cleaner asset to take out a lot of the unknown variables. And if the market decreases 30% on you, you've created a lot more values that you're still above water, where that's the sad thing about multifamily value add. Sure, you can double your money in a few years if you're lucky with the good market, but again, all you're doing is trying to bump the net operating income by 10 to 20% to double your money. And if the market values go down on you and you get unlucky, then you could be losing money. And that's the unfortunate truth of kind of all this. And that's where the only way to mitigate that is to go to higher value add type of projects such as development. And I think that's where a path that I've seen other operators take, and that was a path that we wanted to follow in this perpetual swimming upstream concept. But that's what I've been seeing personally. At some point, I'm going to not want to take all this chance. And maybe one day I'll just retire like you and be a completely passive investor or invest in T-bills.
Thank you for sharing.
Kevin, your question. So to date, invested 2 investments totaling $175,000. Your goal is to invest $75,000 to $100,000 per year for the next 7 to 5 years. Yeah, I think that's a very standard goal that people will have. This concept of dollar cost averaging what you can save per year into 1 or 2 deals, maybe one every 6 months. To me, that's the game plan. And it's been very fortified, especially after this late drop this last couple of years in commercial real estate. Now, the question that you pose is, should I be investing $50,000 a deal for diversification? Yeah, as small as you can to get in to diversify until you have maybe a couple dozen deals. At least that's what I did. Just know that $50,000 these days is getting to be on that fringe in terms of the more reputable operators will want $100,000 minimums. So you may have to play around with that number. But essentially the concept is, especially when you're starting out, try and diversify and spread it around to get a certain level of diversification. I generally think for most people that's having $500,000 deployed over several years, maybe that you call that 10 to 20 deals, somewhere in there. I've got, I don't know, 80, 100 deals. It's a little overwhelming, but for me, this is what I do. So I maybe cut that in half. I don't think you need more than 30 to 40 deals. Maybe you do because you like it. But that's the nice thing about the fund model, right? Investing in these funds as opposed to these single asset LLCs where you don't have diversification in that. That was the last of the Q&A that was posed in the Q&A box. Anybody else want to ask a question before we get going here?
A last question, the checklist that you mentioned, is it applicable to all asset types, whether it's mobile home parks and everything, or is it very much catered towards multifamily homes?
I think like self-storage and mobile home parks, I think it does apply to that somewhat because you're a B2C type of business and you're essentially renting out boxes to people. But
Right.
look at it from a real high level. It's similar. Some of the occupancies ranges might change. Like normally multifamily, your full occupancy will be somewhere between 92 and 95% occupied. That's considered 100% or good. Obviously, some markets may be higher or lower, where plus or minus a few percent points. But when you start to look at mobile home parks, the normal set range for full occupancy might be a little lower, like 85%. So there's some nuances on that. I don't know if that is really in the scope of understanding required for LPs, but just to use that as an example, you're a smart guy. I know you understand this and take things holistically, but just look at it from more of a high level when you start to use it outside of the multifamily world.
Okay.
But I think one big mistake I see investors make is they start diving into other asset classes right away. And because it makes sense, right? All this stuff is cool because these are like things that we need. These are necessities, not some random things on the stock market. And these are thriving existing businesses. So I get the whole concept of people are like, yeah, this is amazing. Let me get some of this, give me some of that, some of this. But more often than not, people are like over diversifying and just spraying and praying. And it typically falls in everybody invests with the same self-storage operator that's really good at marketing and really hasn't done anything other than make a great PDF of their track record and how they've become top 50 Inc. companies, which means nothing. You just pay to play to get those stupid stickers on your website. But that's what you need to figure out is what's marketing and what's real out there. And that's where your network is your net worth and why people need to huddle around real investors actually doing this stuff than making a best educated guess from going through the e-course. And then nothing replaces investing your money and being in it and going full cycle. Unfortunately, that takes a lot of time. What you really learn is when you lose some money here and there, but hopefully if you can surround yourself with a bunch of good people, you can mitigate some of that exposure and magnify your learning through other people's experiences. But after a while, I think where I want to get you guys is like that spreadsheet. Just take a couple hours and go through it, but never look at the damn thing again. Like that's really how you should use it.
Thank you.
I think you're coming to Vegas, so I think you'll see after a while, right? Getting yourself to good knowledge base, but then you start to mix it up with some people who are actually doing it. You build relationships over time. And then this was all kind of an afterthought, but you built that base level of knowledge. But there is risk involved in this world, but I think overall it's worked for me personally. And I think it is very life-changing. And that's what I want to expose people to. But make no mistake, you got to turn your brain on. This is not the close your eyes and invest blindly in Wall Street kind of method. So next time we're going to be going over syndication documents and other asset classes, and then maybe dive through some of the bonus sections of the e-course.